Hello, options traders. Well, just what you needed, more volatility, right? As we wrap up 2018 here, we've been in some incredibly volatile markets. So I thought it was important to show you a neat little trick you can use to figure out how much your stock price can move in a day. And that's an important thing to understand because if you don't have a handle on that, what's going to happen, you'll either put yourself in a position where you'll have expectations of profits that just have a very low chance of happening, or worse yet, you'll put yourself in trades where you're exposing yourself to risks that you're just not willing to take. Well, we need to turn to a concept called volatility, and then I'm going to show you a neat little trick of how you can convert that to a daily calculation, and that's going to give you your answer. So let's get started with volatility. So volatility is a mathematical concept. It's just a calculation. And loosely speaking, it is the measure of how much the daily stock's price moves from the average. It's a very general definition. It's not perfect, but it's even more than that. So let's say that this is our stock price chart down here, and here's the average price. Maybe it's trading at 100. If I have one stock trading like this, a lot of back and forth, even though it may not be very large ranges, maybe it's plus and minus $3, but there's just a lot of back and forth. That's going to generate a very high volatility number compared to a stock that might look like this. It might have higher highs and lower lows, but it just doesn't have a lot of back and forth. It's not changing directions as quickly. So volatility is really more than just the deviation from averages. For those of you who have had statistics, the volatility number is a standard deviation. But for our purposes, the only thing you need to understand is that your broker's platform is going to show you a volatility number. And it will always be expressed as a percentage, 20%, 27%, things like that. And second point is that that number is always assumed to be over the course of a year. That's important. So even though we might calculate the volatility over the past 30 days, and if the platform reports it as 30%, that's assuming that the volatility stayed that way over the course of a year. So we're going to have to take that number and convert it to daily volatilities, and that's what we'll show at the end. But for right now, I just want you to understand the concept of volatility. All right, well, that's all fine and good, but why is it important? Well, to answer that, we have to go back to the 1800s to an ingenious device developed by a man named Sir Francis Galton, who was looking at really genetics, and he was trying to get a handle on randomness. And he created this little device. You've probably seen them in museums. They'll use ping pong balls and they'll drop them through these pegs. This is just a digital version. So watch what happens once we start dropping these through these pegs. You're going to see they get filtered through, jarred around a little bit. Sometimes they bounce right, sometimes they bounce left. But on average, they bounce left and right about an equal number of times and land in the center. At least that's what it's looking like so far, right? So you can think of this as that each time a ball strikes a peg that it has to flip a coin. And if the coin comes up heads, it bounces to the right. If it comes up tails, it bounces left. So once again, you would expect if you flipped a coin, let's say 10 times, that you're going to get about an equal number of heads and tails and should therefore land somewhere in the middle. But every once in a while, you're going to get those freak outcomes where the coin just goes heads, heads, heads. You might get 10 heads in a row, and you're going to land out here somewhere. Or maybe it's going to land tails 10 times in a row, and you're going to land way out here to the left. So don't confuse unlikely with impossible. If you sit there long enough, you will get those extreme outcomes. But the important thing to understand here is that when you have a random process, these little ping pong balls here don't know if they're going to bounce left or right. You're going to end up with some type of a bell-shaped curve at the bottom. All right, well, that's all fine and good. Why do we care about that for the stock market? Well, good question. Here's a stock price model that I built in Excel, and we're going to create a $100 stock. I'm going to inject it with 20% volatility, and I'm going to turn it loose for 250 days, which is roughly the number of trading days in a year. So we're going to let it go, and there's one possible path that the stock could take. I'm going to create a second identical stock and turn it loose, again, 250 days. Do it a third time. Kind of interesting, we're seeing that they all start and stop roughly right there at 100. Do it again. Not always the same path, is it? And that should be obvious. If this was a coin tossing experiment for 250 trials, you wouldn't expect to get the same series of tosses, and that's what's happening here. But the end outcome is roughly the same. However, if we stood here long enough and did this thousands of times, we would get a shape that would look something like this. And even more interestingly, if we went and created little tiny buckets down on that final day, maybe 10 cents wide, and we counted the number of times that the stock price landed in that little bucket, what we would find is we would get a bell curve down here. That's right. That's why this is important. Because when you look at a stock price moving through time, if we were to turn this on its head, we would find this bell curve looks exactly like Galton's board. With Galton's board on the right, the pegs were creating the volatility. What's creating the volatility for the stocks? Well, it's information. Sometimes the information is good, or information might even just be more buyers and sellers at a given moment. But it's just random noise. And sometimes particular trades get pushed up in price, sometimes they get pushed down, but they're just kind of getting jarred around through time. So if we know that stock prices follow a bell curve, we can get a handle on how likely our stock price is to land in some certain ranges. Well, how do we do that? For that, we have to go back to some statistics, and many of you might remember from some college days here, a thing called the Empirical Rule. And what it says is that if you have a bell curve, no matter what the shape, it could be tall and skinny, it could be short and wide, but as long as it's a bell-shaped curve, that about 68% of your data will fall in what's called one standard deviation. And that's in this chart below, this light blue area right here. So 68% of our data will fall in that range. 95% of our data will fall within two standard deviations. And in the graph down here, that's going to be the light blue area plus the dark blue. And then finally, almost all, or about 99.7% of all of our data will fall within three standard deviations. So that's this entire curve right here. Don't confuse that to mean that three standard deviations is the final frontier. There's a fourth and a fifth, and they just keep going on forever. But for practical purposes, after three standard deviations, the probability of getting out there is so slim, it's just not, again, a lot of practical use. So three standard deviations for most applications is kind of the ultimate limit. So once we have a volatility number from our platform, what does it mean and how can we interpret it? Well, here's the way you do it. If we have a $100 stock with 20% volatility, one standard deviation is 20%. Remember, that's a standard deviation. So I'm just going to take that 20% number, again from my broker's platform, multiply it by the current stock price of 100, and I see that $20 right here is my standard deviation in terms of dollars. Now just apply your empirical rule. So I know that there is a 68% chance that that stock will be somewhere between 80 and 120 at the end of the year. That's just adding 20 to 100 and subtracting it from 100. Plus and minus one standard deviation occurs 68% of the time. So I just kind of work the logic backwards and say, therefore, there's a 68% chance that this stock will be somewhere between 80 and 120. Well, if one standard deviation is $20, two standard deviations is $40. So I can take $100 plus 40 and $100 minus 40. And that because that's two standard deviations, I know that there is a 95% chance that that stock will be somewhere between 60 and 140. Wider range, more confidence. And then finally, three standard deviations would be plus and minus $60. And therefore, I would have almost 100% certainty that that stock will be somewhere between 40 and 160 at the end of the year. Let's go back to the Excel model and take a look at this. Remember, this is real data. It's not made up to fit. The Excel spreadsheet just went off on its own, and this is what it generated. And we come up with a bell curve down here, but take a look at the high side. Almost to the penny right at 160. Exactly the maximum number we calculated on the previous screen. What's the low number we came up with? About 40. And look right down here. It's about where the bottom is. So once again, even though theoretically this stock could get above 160 or fall below 40, It's not real likely. So it's this 3 standard deviations that limits most of the trading. Here's a comparison of 20% volatility on top to 10% volatility down below. Notice with 10% volatility down at the bottom, it's a much more focused kind of beam. You would get a very tall, skinny bell curve. The stock prices don't spread out as wide. So this is a good visual to show that the more volatility, the wider the range of possible prices. What would happen if we compared 20% volatility to 40%? Well, now this is what it's going to look like. Look at your bell curve now, very short and wide. Stock prices are all over the place. And that's just with 40% volatility. Believe me, especially in today's markets, you're going to see 50 and 60 and 80 and things even much higher. And you have to understand what that possibly means for your stocks. All right, now that you understand a little bit about volatility, when your broker's platform gives that to you, remember it's always in terms of an annual number. We would interpret it saying at the end of a year, this is where we would expect these stock prices to be. Well, sometimes it's nice to know what's going to happen daily. Well, to find the daily volatility, you divide the annual volatility by 16. I know, you would think you would divide it by 250, the number of trading days in a year, or possibly by 365. Well, volatility doesn't quite work out that way. And that's because volatility is proportional to the square root of time, and there's roughly 252 trading days in a year. Square root's going to be very close to 16. So we usually just round it up and we divide it by 16. Makes it a much easier calculation. So if your broker's platform shows 20% volatility, we divide that number by 16 and get 1.25%. That's 1 standard deviation. And now the calculations are exactly the same that we did for the year. So I know that 1.25% of my $100 stock is $1.25. And therefore, I would expect it to move plus or minus $1.25 per day, 68% of the time, or roughly about 2 out of every 3 trading days. That's just 1 standard deviation. So 2 standard deviations would be $2.50. So therefore, I would expect it to move plus or minus $2.50 per day, 95% of the time, or about 19 out of every 20 trading days. So 3 standard deviations would be $3.75, and therefore I would expect it to move plus or minus $3.75 almost 100% of the time. That is per day. Now, please don't confuse this to mean, therefore, it can move $3.75 today, $3.75 tomorrow, and we can scale it out times 10 for the next 10 days. The math doesn't work out that way. You have to remember this is a daily volatility, but it will at least give you a sense of just how much you can expect for your stock price to move in a day. All right, so now that we understand the basics, how are you going to pull this information off your broker's platform? Well, let's go over to the E-Trade platform and take a look. So here's the E-Trade platform, and I've chosen Amazon. Amazon's trading at about $15.66, up $45, or right, just now jumped to 3%. And most platforms will show you the volatility in a number of places. Now in E-Trade, they have it over here. This is actually not implied volatility. This is the actual volatility at about 52%. I can also find it over here on the quote screen. Nice little graph down here. This actually shows you the historic volatility in blue and the implied volatility in orange. And I'll try to do a video here sometime soon on the implied volatility. But there's your historic volatility, 52%. But kind of a nicer way to do it, one I like to use, is to go over here, go in your chart, choose Studies, All Studies, and right here, Historical Volatility. And if I select that, number of choices I can put in here for my defaults. Normally you're going to use the closing prices, but there are other choices, but volatility is usually calculated using closing prices, so we just leave that default. The period, how many days do you want to use in your calculation? The default is 10, so that means we're going to look back 10 days, do our calculation, and come up with an annualized figure for volatility. If I want to go back a month, I would put 30 in here. So for right now, I'm just going to leave this at 10. Number of days per year, remember there's about 252 trading days per year, so I can choose that, or I can use 365. Not going to make a huge difference, so I would just leave that at 252. And then standard deviations. I would normally leave this at 1 because it's easier to just scale it out on your own once you have one standard deviation, but you can type in any number in there that you want. So we click on Save, and we get this nice little graph down here. I'm going to raise it up. And this number over here in black, about 47.5%, is our current historic volatility based on the last 10 days. Remember, that's what I chose in my settings right there. So it's telling me that we're operating at about a 47.5% volatility. However, you can see that even volatility can be volatile. Look at this. Just back in November, we were up pushing 75, 80%. And then prior to October crash here, look at this. We were down at 15, 20% for Amazon. But right now we're at 47, almost 48%. So now what does this mean for me? What am I going to do? I'm going to take this number. I'm just going to call it 48. So let's take 48%, and I'm going to divide it by 16, and that gives me 3%. And we get a nice round number. Not always going to be the case, but that just means 3% per day. So the stock is trading for $15.65, so that means $46.95 per day. Let's just call it $47 per day is what I can expect. That's one standard deviation. Remember, that's what I put in the default was one standard deviation. So that means I can be about 68% confident that this stock, at least in this period of time right now, has the ability to move about $47 per day. And that's with 68% confidence. Well, what if I want more confidence? What if I want to go out to 2 standard deviations? Multiply that by 2. That gives me 93.9, almost $94 a day, up or down, is what I can expect. So by understanding the historic volatility and how to scale volatility, it becomes a nice little tool you can use to get a handle on just how volatile your stock is and how that can change over time. So the final point about volatility to remember is that this assumes that the only thing driving the stock's price is random information. We're not assuming that they're going to announce earnings and have horrible earnings and get cut in half, or that there's a buyout. We're assuming that it's just random information operating at about 48% volatility level. So hopefully that will give you some new tools to help you survive through these volatile markets. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab, and you can find those at optionsato-z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.